impacts those of you who are looking to purchase a home. If we haven't met, my name is Chelsea Winstead. I am a home financing strategist and a mortgage broker. Let's kind of get into what this actually means. So a lot of the time when the Fed makes an announcement like a cut, there's like headlines, it's all over the news. It gets a lot of people's attention, but let's talk about the reality of how that's actually going to impact you if you're looking to purchase a home. Okay, as a quick reminder, the Fed, aka the Federal Reserve, their responsibility in our country is to try to maintain the economy. They really are looking and make decisions and based on the two like major factors that I always see, which is going to be inflation and unemployment. So last week, they lowered their federal funds rate by 25 basis points, which is 0.25%. A lot of people think that when they see that mortgage rates are going to have like a direct impact from that. It's not. But let's talk about like what this reality is. So first of all, this is a third straight rate cut in 2025. This is actually the lowest that this level has been since late 2022. However, this vote was actually more divided than usual. So 9 members voted for the rate cut, but 3 did not, and 2 preferred no change at this meeting. 1 wanted actually a larger cut. So that's actually the highest number of like no votes in years, which signals that there's some friction within the Fed and basically like what the opinions are of the members of the Fed. Okay, so as I always explain this, like why this decision was made. So number one, job market has weakened compared to earlier in the year. So hiring is softer, unemployment numbers are up. The reason why this happened, so job market has weakened compared to earlier this year. So hiring is softer, unemployment is up. Inflation remains above their 2% target. So recent data is showing it's around 2.8%, though this is moving in the right direction. So there's like this constant battle, push and pull between unemployment and inflation. So a lot of the time, even if unemployment is high, if inflation is also high, you won't see a cut happen. What we tend to anticipate is that if inflation is going down or is steady and unemployment is going up, then we do tend to see a cut. Now, this is kind of a big thing to note. So the message of this, like when this announcement was released, is that, you know, the like Fed officials did not signal a huge like promise of future cuts. So the projections released based on this decision has essentially like been said that there's maybe going to be one more cut next year, but there's not like this mass push for multiple cuts. How this impacts you if you're looking to buy homes. So this is always what's really interesting about this stuff. I always say that, you know, media actually drives more behavior than the actual number. The reality is that when the Fed makes a cut like this, actually it's always like the week before that you see rates come down in the anticipation of the Fed meeting. Typically the week of the Fed announcement, there's not actually any movement at all. And so when the Fed makes a cut, a lot of the time the mortgage rates actually tick up that same week or that same day versus them falling, which seems like so ass backwards because of like the way that these things are explained and presented to the press. So right now, mortgage rates, I would specifically like conventional loans are hovering in the mid 6s like nationally. And most analysts are not expecting any additional dramatic drops throughout the year or even early into January. Also to give you some context, so when the Fed makes a cut, so they control the federal funds rate, which is more influential on short-term lending between banks, not on like mortgage loans. So where people often feel this like the quickest is going to be things like credit cards. This will be things on like auto loans or personal loans, for business owners, like business lines of credit. So typically if the loan is variable or short-term, the Fed cut matters more and there's more of like an immediate impact. Mortgage rates don't follow the Fed funds directly, and mortgage rates are tied to long-term bonds, not the Fed's overnight rate. So as mentioned, you know, if markets expected the rate cut, which we did, we often see that priced in prior to the announcement happening. So I always say like your biggest hack is the other thing too is you have to just be aware like of what the inflation and unemployment reports are saying. Big thing that kind of jumped us up at the end of this year was the government shutdown. So a lot of reports that should have been coming out month over month were not because everything was shut down and now the reporting is delayed. So I actually think that if the government would not have been shut down, we may have seen like some different things happen. But with that said, you know, again, I think the market was expecting there to be a rate cut announcement, which there was. So actually the week before the rate cut is when most of the rate improvement happened. Actually, you know, when the announcement happens, normally that day and a couple days after, you do see the rate tend to go up a little bit, but not dramatically, like not a huge spike, but it does go up. Here's something though that you should know. When the news does mass publication of this announcement of the cut. Even though on paper, these like cuts don't actually make a huge difference, the media creates a stir and like a interest in people moving forward. So, over the past couple of weeks, we've seen mortgage applications go up because the news is talking about these rate cuts. So when the perception is that cuts are happening, that's when you get all of the inbound interest and people jumping back into the market. That is what we are seeing. So I would say, for those of you that are potentially interested in buying, this is what I would say. A couple things. So when there is like worry amongst the economy, right? And so, government shutdown, you've got all this, like, we're still dealing with the overall like changes from the tariffs. Like a lot of people freeze when there's a lot of ruckus or movement going on. But when things start to like settle in and kind of stabilize, that's when you see people feeling more confident in moving forward. What is going to happen is this. Because there's no, at the moment, major headlines of like worry or like distress, right? Government's back open, blah, blah, blah. As we wrap out December, you're going to see a lot of buyers come back to the table who maybe were looking in 2024 because the news is saying that rates are lower. So they're going to come back to the table and be interested in buying. And or if people are wanting, to purchase, that information that's pushed out is encouraging them to be like, hey, maybe we should figure out what's going on now, because it seems like, interest rates have gone down. They are staying low. So, maybe we should figure out what's going on. So this would be my recommendation. Q1 historically, just in general, typically brings about less buyer competition than the springtime. It's cold. People don't like to move in the cold, like there's just less activity. What I would say is that before you see the surge of buyers re-enter the market in like April to June timeframe, January, February, March are really great months to still have a lot of negotiation power as a buyer. Also because sellers at this time are not seeing a ton of traction, so they are going to be way more likely to negotiate and, be open to different opportunities to get their home sold. My expectation, especially based on, I help hundreds of people on this app every single month create a plan to purchase a home. What I am expecting to see is as rates continue to, they're in the mid, depending on what kind of loan you're getting, they are obviously a lot lower right now than they even were 6 months ago. And I do think that as we continue to see that kind of stabilize and stay at that level, more people are going to come back to the table and start running numbers again. And we're going to see an increased amount of buyer activity in 26 compared to 25. So with that said, this all starts with a strategy, running numbers, figuring out what you can personally and realistically take advantage of. If you would like to create a game plan together, I would be more than happy to support you, talk through your options, give you personalized numbers specifically in the market that you live in. Link on my profile is the best way to get started. There's a couple options there that you can pick from. But ultimately, I would say, if you are a buyer and you were interested in purchasing in 2026, if you have the capacity and the ability to potentially make that happen in Q1, I do believe you're going to have stronger negotiation and more control as a buyer as compared to like Q2 or Q3. If you have any questions, comments are always open, and I will see you guys soon.